What's going on, everybody? Welcome back to yet another video. In today's video, I'm going to be giving you guys an ICT master course. I'm going to be showing you the two ICT concepts that I personally use in my trading. Now, there's a lot of different ICT concepts. However, these are the only two concepts that I use in my trading, and you're going to learn these concepts in the fraction of a time. So if you do find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But without further ado, let's hop into the video. All right, so the first concept that we're going to go over is the fair value gap. This is honestly probably one of the most popular ICT concepts. So I'm going to break it down for you guys, and I'm going to show you what I look for in fair value gaps to identify high probability setups. So what is a fair value gap? A fair value gap is a 3-candle formation. Typically what you're going to have is this first candle is going to be a smaller body candle. It could be a red candle, or it could be a green candle. It doesn't really matter. On this chart, I have blue and black, blue being a green candle, black being a red candle. But this first candle has to be a smaller bodied candle. Now, the next candle is going to be a large aggressive move away from that first candle. So you can see we have our small candle here, and then a strong aggressive move away. Now on the third candle, this is typically again going to be a smaller body candle, but what you want to make sure is the low of this third candle does not intersect with the high of this first candle right here, because in this portion right here creates an imbalance in the market and leaves unfilled orders. So the next time price trades down into that level, the idea behind the fair value gap is it starts to pick up those orders, in this scenario buy orders, and makes the next move up. So as long as the lower portion of this third candle does not intersect with the high of this first candle, it is considered a fair value gap. The fair value gap is going to be the difference between the high of the first candle and the low of this third candle. And again, we're looking for price to trade back down into this level. Because this is a bullish fair value gap, we would want to look for bullish price action somewhere in this range to then confirm a long entry. So not only do we have bullish fair value gaps, but we also have bearish fair value gaps. Now with a bearish fair value gap, the first candle, again, it's going to be a smaller candle, and then we're going to have that large aggressive move down, creating an imbalance in the market. Now this first candle, it doesn't matter if it's a red candle or a green candle, and this third candle does not matter if it's a red or green candle. What matters is this is a large aggressive move down away from the low of this first candle. Now, same thing. You want to make sure that the high of this third candle does not intersect with the low of this first candle right here. If they do not intersect, this is where the imbalance is going to be in the market, and this is where sell orders should be waiting to be filled. So now the next time price trades up into that fair value gap, you want to start looking for bearish price action for a short entry, and you can see that's exactly what happened today. So in this scenario, to draw your fair value gap, you're going to take the low of that first candle, connect it to the high of that third candle, and then you're going to project it forward. So again, here is a bullish fair value gap. Here is a bearish fair value gap. Here is another bearish fair value gap. Now, when it comes to actually using these fair value gaps intraday, you want to understand the overall trend, because the last thing you want to start doing is just drawing random bearish fair value gaps in an uptrending market, because that's ultimately how you're going to lose money. So as we could see again earlier today, the trend was up. However, once price dumped to the downside, it took out these previous lows right here before coming up and setting that lower high. So an example of a bearish fair value gap that I would not use is on this move up. We have this very tiny bearish fair value gap. I wouldn't draw this on my chart because the trend is clearly to the upside. Instead, I would want to be looking for price to trade down into a bullish fair value gap. So again, to understand which fair value gaps you should be looking for, bullish or bearish, you need to understand the overall trend before drawing them. Now, before moving on to the next concept, I'm just going to go ahead and draw some more fair value gaps. That way it helps you guys identify them in the future. So here's a bearish fair value gap right here. Here's a bullish fair value gap over here. Here's another bearish fair value gap over here, and another bullish fair value gap right there. Now, again, not all of these are necessarily ones that I would use to trade. I'm just showing you guys how you would go ahead and draw them again, so you can identify them intraday. Now, as far as time frames to draw fair value gaps, I personally like to use mine on a 5-minute or a 2-minute time frame, but it really depends on what kind of trader you are. I know traders that like to use 5-minute. I know traders that like to use 15-minute. I also know traders that even use them on higher time frames, such as an hourly. I know swing traders that use them on even higher time frames, such as the daily or the weekly. So it really depends on what kind of trader you are and just the overall setup in general. Now, again, before we move on to the next concept, I want to stress the importance of confirming the fair value gap with price action and volume. You don't want to be that person that's simply just selling because price came up into a fair value gap. And you don't want to be that person who's buying just because price came down to a fair value gap. Always confirm with price action. If price comes down into a bullish fair value gap, look for bullish volume and bullish price action to confirm your entry, and then your stop loss will be on the opposite side of the fair value gap. If price comes up into a bearish fair value gap, you want to look for bearish volume and bearish price action to then get short, and your stop loss will be on the opposite side of the fair value gap. Now, another thing you can do is use moving averages, which I really like to do, such as the 8 EMA and 21 EMA. A setup that I really like to take is when we have a fair value gap plus a moving average inside of that fair value gap, because at that point it's pretty much just double confirmation, and it gives you a better spot within that fair value gap that you can look to either go long in this scenario over here or to go short. Now, another thing you can do to identify entries is you can simply just measure the high to the low and then watch the 50% retracement within that fair value gap to get long. And then it would be the same thing to the downside. If you had a bearish fair value gap, you would take the low to the high. Again, you can use the moving averages, or you can measure the difference between the low and the high of the third candle right here and watch the 50% retracement inside of that fair value gap for a short entry. So that is the first ICT concept that I use in my trading strategy. Now, the second concept that I really like to use is liquidity sweeps. Now, when it comes to liquidity sweeps, pretty much what they are is an area in the market where both sides end up getting stopped out. So say we're just looking at just a consolidating chart right here. We have this resistance point up here, and we have this support point right down here. Now, if there are short sellers in the market, where do you think their stop loss is more than likely going to be if they're selling short up at these highs? Their stop loss is going to be right above the highs. Now, also at the same time, you have breakout traders who are looking to go long if price breaks above resistance. So what happens if price trades above this previous high? Everybody who was selling short is going to get stopped out because price broke above resistance. And then also at the same time, you have breakout traders who are going long because price broke above resistance. So the short sellers had already gotten stopped out, but now what happens if price breaks below the previous resistance? That's where these breakout traders are going to have their stop losses if price fails to break out and hold above resistance. So as price trades back down below the resistance point, it stops out both sides of the market and usually will fuel a move to the downside. Now, on the flip side, if we have a support point right here and traders are trying to get long off of these lows, where is their stop loss more than likely going to be? Right on the opposite side of this low point right here. So traders getting long, stop loss right below here. What happens if price trades below that support point? They're going to get stopped out. Now, on the flip side, again, you're going to have breakout traders who are going to try to sell short as price breaks below support. But what happens if price reclaims support? They're more than likely going to get stopped out of their trade. That's where their stop loss is, if price fails to hold below previous support. So typically when this happens, both sides of the market get stopped out, the long buyers, the short sellers, and that there then fuels a strong aggressive move to the upside. So let's go find some examples on a chart. All right, so before showing you guys liquidity sweeps on charts, I do want to show you guys a couple of trades that I've taken in the past based off liquidity sweeps. So this one was more so an intraday liquidity sweep. We can see that intraday SPY was building this pretty solid base at 434.68. You see we had support here, support here, support here. Now, if buyers are getting long at this level, where do you think their stop loss is more than likely at? Right on the opposite side of this 434.68. Now, on the other hand, you have short sellers that are looking to sell short and catch that next leg down if price breaks below 434.68. So as price breaks below the level, these long buyers end up getting stopped out. And then at the same time, you have those short sellers who are trying to catch the next leg down. As price reclaims 434.68, they get stopped out as well. So at the end of this candle, getting long provided an amazing risk to reward with your stop loss right below this low. And then you can see price had a very strong aggressive move to the upside. After the London session open, which is going to be 3 a.m. Eastern time, I like to mark out the pre-market high and the pre-market low. Now in this scenario, you can see it actually happened both ways. We had resistance here, support here. PPI in the morning broke above this resistance point, again creating liquidity, both sides in the market. Anyone who was short more than likely had a stop loss above here. Anyone who tried to buy that breakout got stopped out as price reclaimed this level, which then fueled a very strong aggressive move to the downside. Now same thing, anybody who was long more than likely had a stop loss right below here. Anybody who was looking to get short more than likely shorted as price broke below pre-market low. That's a basic thing that we're taught as traders. Long the breakout above pre-market highs, short the breakdown below pre-market lows. I'm sure most of you guys have heard that. So the long buyers get stopped out. The short sellers end up getting stopped out as price reclaims the level, setting up for a high probability long trade with a stop loss right below this low. So now actually taking a look at the chart. Here's a really good example right here. You can see that price has this resistance point, 1 hit, 2 hit, 3 hit. If anybody's looking to go short, where do you think their stop loss more than likely is? Right above these highs. For breakout traders, where do you think they're trying to get long as price breaks above resistance? As price gets above resistance, it stops out the short sellers, entices long buyers to get long, and as price comes back down below support, they get stopped out as well, fueling a strong aggressive move down. And then here's one more really good example. You can see in the overnight session, we did have this really strong support point on the ES futures. Anybody who was long in this area more than likely had their stop loss right below these lows. As price trades below it, they get stopped out. Also, anybody who's looking to short below the London lows, they end up getting short here, stopped out as price reclaims the level, which as a result fuels a strong aggressive move to the upside. You can see price came back, made a support again before making that large aggressive move up. Anyways, that's going to wrap up this video on the 2 ICT concepts that I really like to use in my trading. Hopefully you guys did find a lot of value in this video. And if you guys did, as always, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me, especially because I do put so much time and effort into these videos. Everybody have an amazing rest of your day, and I'll see you guys in the next one.